Benjamin Franklin famously once said, "By failing to prepare, you are preparing to fail." And now guys, we are in July 2020 and I thought I would shoot a video showing you a quick company profile and the company financials of the top 3 companies that I'm preparing to buy for the month of July. What's going on guys, my name is Emmanuel and welcome once again to my channel. And guys, we have reached the end of yet another crazy month in the stock market and I hope you guys have had a profitable June. June has been a very busy month for myself. The markets dropped quite significantly, I believe on the 11th of June. And during that drop, I spoiled myself. I'm not gonna lie here and say I was sitting on cash. Nope. I added 3 new growth companies and 3 new dividend companies to my portfolio, and yes, I'm very happy with my position. So for July guys, I have 2 brand new companies that I've added to my watch list and 1 company that I already own. One I consider to be a solid dividend paying company, the other is more of a growth company, and the last one I would consider to be a turnaround company. I will show you my price targets for all 3 companies and hopefully they're triggered so then I can start building on my position. Don't forget to smash the like button guys, as it really helps my channel grow. And if you're new here, I want to say welcome and I hope you enjoy today's content. And if you do, please hit the subscribe button, as it will be really cool having you on board. And with all that said guys, let's take a look at these 3 wonderful businesses. Alright guys, so the first company we're going to be looking at today is MasterCard. Ticker symbol MA, and I'm sure if you check your wallet or your purse, you probably have a MasterCard debit or credit card, or possibly a Visa, or if you're in America then you have the American Express. But what's the story? Okay, so this actually was quite interesting. MasterCard are actually considered to be a tech company, and they're responsible for connecting consumers, financial institutions, merchants, governments, and businesses all across the globe, okay? And they pretty much enable everyone to use electronic forms of payment. So I've got quite a significant holding in Visa. A lot of shops in the UK no longer accept cash as a form of payment now, so I really think card payments are the future. And also users can make payments with a range of MA payment solutions. So again, MasterCard or Maestro or Cyrus. MasterCard and Maestro are what I find is quite common in the UK. Okay, I've never really seen a Cyrus card. So what are their recent expansion plans? And one of the things I highlighted in my Visa analysis was the US-China trade deal. And MasterCard was actually included in that trade deal. So I'm going to take you to that trade deal now. Okay guys, so in the trade deal on article 4.4, China has pretty much said that they're willing to accept any application from a US electronic payment service supplier. Okay, so these companies will have to pretty much apply to be able to operate and run their businesses in China. And China have mentioned here that China shall accept license applications of such US suppliers, including any license applications of MasterCard, Visa, or American Express. Okay, so I've got a significant holding in Visa, but MasterCard has been looking a lot more attractive to me, especially as the price has been dropping in recent weeks. Okay guys, so that's really why I've shortlisted MasterCard as one of my top stocks for July. So how does MasterCard generate revenue? And I'm sure you probably know they generate revenue by charging financial institutions that issue MasterCard branded payments, so payments on the fees based on the volume of activity. So every time you use your MasterCard to make a payment, MasterCard pretty much charges the financial institution a fee. So who are the main competitors? So as you've seen in the trade deal, Visa Inc. are pretty much their main competitor, followed closely by American Express. And I will actually link a video to my Visa analysis where I compare all 3 of these companies' financials. Alright guys, so now you understand the fundamental reasons why I'm interested in MasterCard. Let's take a look at their financials. So I always love to start with their balance sheet, and having a look at their balance sheet guys, they have a total cash position of 10.68 billion versus their total debt, which is 12.47 billion. They are slightly over leveraged by just shy of 2 billion, but I think if you look at their current ratios, the current ratio is sitting at 1.87, which pretty much means they have more current assets than they do current liabilities. So from at least the next 12 months, With a current ratio higher than 1, that means they've got enough assets to cover their financial obligations. I also wanted to bring to your attention, guys, their profit margins and also their operating margins, which is at 56.88%, which is incredible. So the way to think about operating margins, guys, as I've said before in previous videos, if the company makes $100, it keeps $56 of that as earnings, okay? And also, guys, so taking a look at their PE ratio, it's sitting at 37.45, which when you compare, Visa has a PE ratio of 34. So I think this ratio is not too bad. Alright guys, so MasterCard is available on Trading 212. You just search for MasterCard and you can pick up a share for MasterCard for about £238. And for disclosure, guys, I would be looking to build my position in MasterCard at $280. So that's my price point. So if price hits that, I'm going to start building my position, and if it drops lower, which I hope it does, then I can pick it up cheaper. Alright guys, so the second company on my watch list for July that I will be considering purchasing is Disney, ticker symbol DS. Highlighted here that it's actually the risky of all three of my stocks that I have in today's video, and it's the one that I consider to be my turnaround company. Alright, so let's take a look at the story. So Disney, as we all know, is a worldwide entertainment company, and they're actually broken into 4 segments. So the first segment they have is their media network, which is pretty much provides cable, broadcast television productions. The second segment is their parks, experiences and products, so their theme parks, Disneyland. I remember going to Disneyland in Paris when I was a lot younger. Their attractions as well as their resorts. So their third segment is their studio entertainment, which is responsible for producing their movies, motion pictures, animations, etc. And the final segment is their direct to consumer and international products. So again, this is where they develop games for the mobile platform, and also books, magazines, and comics. I remember growing up reading a lot of Disney books, Mowgli. Was Mowgli Disney? I think so. But yeah, guys, so how do they generate the revenue? All of their revenue is generated from all 4 of these segments. So let's look at the percentages. So 37% comes from parks and experiences. Wow. So that's their Disneyland, is responsible for 37% of their revenue. So 35%, surprisingly for me, was their media networks, because I thought their studio entertainment would have more percentage of a revenue stream for Disney, but turns out that I was wrong. So, and then finally you have 13%, which is their direct to consumer. What's the opportunity? Why am I buying Disneyland? It's because they're in crisis, guys. And from my Facebook video, every crisis lies an opportunity. And the theme parks, they were meant to be opening up early July, has now been delayed and pushed back indefinitely. And even at the theme parks as well, their employees have been protesting recently due to lack of PPE. So I'll quickly take you to that article now. So as you can see here, guys, from an article from Reuters, it says some Disneyland workers protest reopening plans amid the pandemic. Okay. And this is even more worrying news. So it says that the company had planned to welcome guests back to Disneyland and neighboring California Adventure starting July 17th, but delayed the restart date indefinitely. Alright guys, so with all of this crisis surrounding Disney theme parks being delayed, to top it all off, they're now having to push back blockbuster movies, to August, which again further affects their revenue, because again that you're talking about 37% of their revenue plus 16% of their revenue is being hit on a daily basis. The more they have to delay and push things back, the less revenue they're making. And therein lies the opportunity, in my opinion. I don't see this being the end of the parks and experiences segment, and I don't see this being the end of their studio entertainment segment. And also bear in mind, they're still making money from the media network, so this is why it's important to be diversified, because even though they're struggling in revenue for these 2 segments, they're making money in their media networks, and they're also making money from the direct to consumer and international. So that's my reasons, guys. Okay guys, so now you have an idea of my fundamentals and the reason why I'm looking to buy. Let's take a look at their balance sheet. So as you can see, guys, this is why I said there's a lot of risk. They only have 40 billion in cash and their total debt is 59 billion.
So that is a very concerning figure. They don't have enough cash to take care of their debt. And also looking at their current ratio is below 1, which means their total current liabilities is higher than their total current assets. So they don't have enough current assets to fulfill their financial obligations within the next 12 months. And they don't have enough cash to cover the debt. It's looking very, very worrying for Disney. All right, guys. So if you did want to pick up a share of Disney on Trading 212, you just type in Disney, you click on it here. All right, guys. So my price position for Disney, I would love it to drop below $100. If it does, I will start adding to my position. And if you did want to pick up a share in Disney, one share will cost you £89 on Trading 212. Okay, guys. So my third and final company that I'll be watching closely is Medical Properties Trust, ticker symbol MPW, and they're a REIT, and I actually own about just over 40 or 50 shares in this company already. And if you're not familiar with them, they are a healthcare REIT, and they are one of the world's largest owners of hospitals. They have over 389 facilities in 8 countries across 3 continents. Okay, and the types of hospitals that they own are general acute care hospitals, inpatient rehabilitation hospitals, and long-term acute care hospitals. So how do they generate their revenue? So they generate their revenue from rent. So essentially they own these hospitals and then rent them out to private companies, and then they pay MPW rent every single month. So 84% of their revenue is from the rental that they receive from general acute care hospitals. 13% of revenue comes from inpatient rehabilitation hospitals, and 3% of their rental revenue comes from the long-term care acute hospitals. As you can see, guys, that the bulk of their revenue comes from the general acute care hospitals. Okay, right, guys, so some interesting fundamentals, and the reason why I'm buying more is because during the height of the pandemic, April, May, and even June, MPW collected 96% of rent, which is absolutely impressive. I mean, when you look at a lot of these retail REITs, the rent collections is in the low 80s for a lot of them. So for MPW to be able to accumulate and collect 96% of all rent, that's to be applauded. And I also see with lockdowns being eased, more of their clients will be able to pay their rent, and they'll probably get to 100%. The company has also announced that they reached an agreement regarding collection of all of the deferred amounts, including interest, which were delayed by certain operations, of course, because of the pandemic. So not only are they already making 96% of their rent, they're going to collect, and they're going to collect their 4% on interest as well. Here's an article by Zacks Equity Research, and this is where the announcement was made. So as you can see here, it was announced that it collected 96% of June rent and loan payments, and that was in line with collections made for April and May as well. As well as that, guys, they also completed a 1.5 billion lease agreement to a UK healthcare company called Circle Health. So Circle Health are not really that big just yet in the UK. It's still a lot of the private healthcare sector is still to do with Virgin, but Circle Health are up and coming, and I'll show you their website. Alright, guys, so this is Circle Health's website, and you can see they already have hospitals in Bath, Reading, Birmingham, again all through MPW, and I think as they continue to expand, it seems like they're going to have a great relationships with Medical Properties Trust. And that's the relationship that I think Medical Properties will make a lot of money from. And I'm fully backing this company, all right, guys? So, who are their main competitors? They have LTC, which is long-term care. That's also another REIT. And they also have NHI, which is National Health Investors, which is also another healthcare REIT. Okay, guys, and MPW is also available on Trading 212. You type in MPW, you click on Medical Properties Trust, and my average position at MPW at the moment was round about 1809. That's my average position. So if it does drop below my average price, I will definitely be picking up a lot more shares. They're one of the cheapest stocks from today. If you wanted to pick up a share, it will just cost you £15 per share. Almost forgot, guys. Their dividend yield is sitting at a beautiful 5.86%. And before we go, we always like to look at a company's balance sheet. Their current assets is sitting at 8.21, which is incredible. Typically, REITs don't have a lot of cash because REITs have to pay out 90% of their earnings to shareholders, which is why you can see the difference in cash and their debt. So their cash versus their debt doesn't really apply when you're looking at REITs. And finally, guys, take a look at this beautiful operating margin, 68% operating margin and a 38% for their profit margins, which is impressive.
Guys, I hope you enjoyed my quick analysis of the three stocks that I'm preparing myself to watch closely in July. If you are interested in any of these companies that I've mentioned today, use my video as a starting block for you to build on. And remember, do your own due diligence and analysis before you decide to invest in any company or any stock. A fantastic book that I can recommend will help with your investing knowledge is One Up on Wall Street by Peter Lynch. And also, I'm actually reading Rule 1 Investing again for the second time by Phil Town. The link is in the description below. Grab yourself a copy, guys. Invest in yourself. And if you want to start investing, I would highly recommend my broker Trading 212. Click the link in the description below. Trading 212 will give us both a free share. With all that said, guys, don't forget to smash the like button, hit the subscribe button and the notification bell if you want to see more content from myself. Thank you for watching, and I'll catch you in the next one. Peace.